That's why everybody wants in on venture capital, because you get really rich from the carry if you're a profitable fund. And imagine doing that again and again each time you raise a fund.
Welcome back to Business Law Toolbox, and in this episode we are powered by the LE Fitness, which we are very, very happy about.
Yeah, amazing.
Amazing. And today we're going to talk about venture capital. How do you go from brilliant ideas to master billion businesses? And this episode is for you that might want to learn about venture capital and make a career in it, but also for you as a founder. So we have Kat today here with us that's going to explain it to us as usual, which we are very proud of.
Hello everyone. And this is the first of a master class.
Yes,
Yeah.
So this is the Venture Capital Masterclass, and we will welcome to that one.
Yeah, so if you find this too basic, skip this first one. In the following segments, we'll do deep dives into each issue.
To each issue.
Yeah.
This sounds really good.
Exactly. But today we're going to give you the basics, what you need to know, and it will be helpful, like you said, to you founders seeking that investment, understanding the dynamics. What are venture capital firms all about and what are they looking for?
Yes, and how does everything work?
Yeah.
And also remember, this is not legal advice, it's knowledge sharing as usual.
Indeed.
And talking about venture capital, it's a very sexy word. I mean, everybody wants to be a part of it, and it's a big thing to do.
Oh, yes.
So that's why we're going to explain it now, to just take it apart.
Venture capital is the hottest. And I mean, the successful founders typically move on and start their own venture capital VC firms. So that's kind of, wow, being a partner of a VC firm.
Yeah, that sounds so cool.
Yeah.
But if we start venture capital, what is it?
Well, it's high-risk capital. And we have a series about angel investors.
Yes.
And in that case, if you're an angel investor, you take your own money and invest it into a startup. A venture capital firm gathers other people's money and the manager invests it in a startup.
Oh, so you collect different...
Yeah, it's a pool of investments. And it's bigger ticket sizes as compared to the typical angel. So it's kind of the next level in the startup journey.
And that's why it's so much money in venture capital, because there's a lot more people involving.
Yeah, and bigger investors. The investors are typically institutions, family offices, more professional investors. So huge money. And what you should also know is that this pool of investment has a limited time span.
Okay.
So it doesn't go on forever like an evergreen, an investment company. The manager, the fund manager, they raise capital, just as you as a founder would raise capital. They go to their investors and say, we want to raise for a new fund. They raise the capital, and the fund will have a lifespan of 5 to 10 years. And in that lifespan, they promise their investors that they will, number one, deal source, find the best opportunities, startups and scale-ups. They will support in some way. Some VCs are more hands-on and some are not. They will support that startup, that company, so the value grows, and they will make an exit. So they get the return of investment.
So that's a part of the strategy.
Yeah. And of course, ongoingly, they will raise new funds. So this is kind of a ever-going wheel where they have fund number 1, fund number 2, fund number 3. So what you should know also as a founder is if you bring on VC money, the clock is ticking.
Wow.
And they prioritize growing, not black numbers, not making profit. They want to scale, grow, and then they can make that exit either through a sale or an IPO, going on the stock market, or something else.
So it's like a fast-forwarded fund.
Yeah, it's intense.
It's really intense.
Yeah. And if you look at the structure, you should also know the lingo always.
Which we have some episodes about.
Yeah, and in this case, you should recognize the LP, that is the investors. They're not part of the management of the fund. They invest their money, and of course, they have an investment agreement where you set some kind of rules, what type of investments you're focusing on, how you will split any profits, return of investment. But they're not part of the picking of the companies and the supporting of the companies. That's the GP, the general partner. That's the fund manager who runs the show. He's responsible from fundraising to deal sourcing to supporting to exit. And most typically, you will support by way of being part of the board of directors and other networking, stuff like that. You will not be operative, not that hands-on. So, but different VCs have a different approach.
Okay, so this is more like a short-term way of investment than the angel investment, you would say?
Well, angel investors also want an exit, but since you invest earlier, you should expect 10, 15, perhaps 20 years. But so the VC is tighter and more intense, yes. So it's higher risk because they will not let you as a founder or angel invest at the okay number. If they invested at a valuation of 200, they might want to see 400 or 600 or 800 before they accept an exit. While you as a founder, you might have been happy already at 30 million. So big chance of getting super rich if you make it. But the requirements along the way, because VCs calculate that most of their investments will fail or not make it, but they're looking for that really one, hitting it big. So it's tough as a founder, but also a great opportunity, of course.
Yes, but I think also that the venture capital comes in and have a lot of power over the company.
Yeah,
because they have the big money.
Yeah, and that is, of course, also dependent on how attractive you are as a startup. If venture capital firms are competing to get into the investment, that will, of course, mean that you have more of a say-so. But the VCs have a strong opinion, absolutely.
Yeah.
And then the famous, how do you get rich?
Yes,
right?
Of course.
And there is a typical model where when you have done the exit, so you're closing down the funds, you can either distribute each time you make an exit, or you can calculate everything at the end as a whole. But regardless, number one, the LPs, the investors, will want the return of their money, so kind of preferred right. And then they want a hurdle rate. They want perhaps 8% before you as the fund manager get anything. And then you have a catch-up, but we can get back to that in the episode where we dig deep into the waterfall. That's details right now. After that, you have the world-famous carried interest.
And what is that?
That is when the LPs get their monies back and their preferred return rate, then you split 80-20. So the investors, the institutions and so forth, they get 80%, and you, the manager, get 20%. So imagine that you raised a fund of 100 million, and when you exit, it is worth 300 million. It went brilliant. And then you give the money back, 100 million, and then you say a preferred rate, it ends up being 25. And then what's left, 275, you split 80-20. And the fund manager, the GP, that might be 3 partners looking to split those millions. So that's why everybody wants in on venture capital, because you get really rich from the carry if you're a profitable fund. And imagine doing that again and again each time you raise a fund. So being a partner of a VC is kind of like you don't have to take that individual risk on each startup because you spread the risk among several startups and you utilize other people's money. But if you hit it big, woof.
You hit it really big.
So that's a lot of people's dream, really.
But you hear a lot of success stories when it comes to venture capital. It must be uncommon that it fail.
Oh, good question. I would say no. It's depending if you're talking about one or a few investments or if it's the whole fund that fails. And it's not super transparent. The numbers, when you look at kind of what was the return, how much dry powder do they have, how much did they raise, it's not as transparent as many other financial industries. So it's a bit hard because you tell what you want to tell, right? And often you have the fund located in what we typically call a tax haven. So that can be kind of hard. But I can say that when you raise a fund, if you want to go into venture capital, number one will be your track record. Have you done it before? Or have you founded a company that's done a major exit? And another thing is, do you have access to capital? Do you have the network to fundraise? And do you have the access to the startups? So that's really important.
So things you should think about before entering.
Yeah.
Like requirements or things you have been done for. Okay.
I mean, you have to have a thesis, a pitch. You're going to fundraise. Just as the startups are fundraising to the VC will be out fundraising from their investors. So they have to show, why should you trust me with your monies? Because the money will be locked in for a long time.
Okay.
And I can add, because that's also nice for you to know, is that when you close the fund, let's say you're a big insurance company and you say, okay, I'll put 50 million into your fund, dollars. Then you do not send the money to me directly. You commit that capital.
Okay.
And then once I have deal sourced and I find that perfect investment, I call on the money. I say, now, all of the LPs, I need 5 from you and I need 10 from you because that's proportionate. And I do the investment. So it's a committed capital. It's not that you send it and they sit on it. It's when they can deploy it that you send it.
Okay. Yeah. But you're still a part of the venture capital as a
you
investor.
have committed it.
Wow.
Yeah. And what more? Yeah, when we talked about starting new funds, that could of course be a conflict of interest, because if you paid me 50 in fund number 1, you don't want me to be out fundraising when I should be out investing and utilizing your money. So typically our investment agreement will say that you can only fundraise again once you have deployed 80% of the capital in this fund. Because you want to save some monies both for new opportunities but also for follow-on investments so you can support companies.
But are there any big risks to join a venture capital? I mean, it's a lot of money, so...
Yeah, and you want skin in the game also from the partners. So typically there's some up and some down. I mean, you have to commit something and you have it's a long game. When you start off, you have to wait for your first return of investment for 6-10 years perhaps. So, and it's a tough game, really.
Yeah, I can hear that.
Yeah.
I can really hear
it's
that.
Not for the weak-hearted. It's intense and you work day and night.
Yeah, it seems like it's very intense.
It is.
So, I mean, hopefully people will have some more information to start.
Yeah.
But what is the absolute first thing that you would recommend to someone to be a part of the venture capital career?
Oh, get a business education, do a startup, start from the ground. I mean, do the hard work. Yeah. I mean, competence attracts, and many VC firms are very open for diversity and different backgrounds, being a bit quirky, but you have to have a track record. You have to have something to bring to the table.
Yes, of course.
Yeah.
Sounds amazing.
Amazing.
Is there anything else you need to think about when talking about, for example, if you're a founder and taking venture capital, what should you think of then? What changes in the company?
Yeah, first thing I can say is that when you approach VC, don't be lazy, because they sometimes find that that's the case. Make sure you read up on them and know who they are, both the partners and the VC firm. What have they done? What are their interests? Because, I mean, they raise funds themselves, so they know what works and what doesn't. So don't be really, really ready, both with your own material and knowing who you are talking to. And another thing is, if you're approached by several VCs and they're attractive, look at their track record, but also look at what specific partner or investment manager would be involved, would sit on your board. So cherry pick a bit if you can. That's one.
And of what I heard, when we talked about the angel investment, in when VC companies come in, I mean, a lot of things changes in the company.
Yeah.
You might already have some investors that are like owning a small stake in the company. So, I mean, it seems like a very big step to take as a founder to bring on the VCs.
It does.
Bring on the big guys.
It turns the heat up.
Yes.
It really does. And as an angel investor, you should expect to only be a minority investor, not having anything to say, really. So it really changes the dynamics and the power. But the VC will want to promote that the founder has a sufficient equity stake. So they do support the founders still having a strong position in the company. So they're incentivized to really build the company. Typically, a VC would take 20-25% if they were talking about the whole round. And then they often participate in follow-on investment.
Well, great explained.
Thank you.
So if you want to be a part of the VC investors in the future, and maybe you're a founder and thinking about bringing on some VC money, then you have this masterclass, and this one was the basic one.
Yeah.
We talked about what a VC fund is and how it works.
Perfect.
That sounds perfect.
Yeah.
So I really hope that this is a good information for you. And do not forget to like and subscribe our channel. And as we said before, this is featured by the LE Fitness, and we are very happy to work with them.
Perfect.
Thank you for today.
Thank you. Bye-bye.
Bye.